Everybody, it's March 17th, St. Patrick's Day, and to my right is Tammy, to her right is Steve, to my left is Paul, and we are broadcasting from Ireland today, from a pub in Ireland. Can you imagine that? We flew over this weekend, and we're really enjoying the St. Patrick's Day festivities and whatnot. We've been reading in the newspapers what's been happening in the United States. We understand Bear Stearns had a problem. It doesn't surprise us if you look at the chart. But it's interesting about what's taking place here. You know, we talked about this earlier, that it almost looks like the tech crash that we had back in 2000, where it was pretty much contained to technology, telecommunications, internet-type stocks, and there were other things that were doing well. The same concepts that we've been talking about to you since November are still in play here. Like Steve mentioned, the bull market and bonds, we still have that. And the relative strength on cash and bonds over stocks is still in place. Bullish percent still in the column of O's, defensive teams in the field, but the good news is it's not giving up that much downward pressure. It's holding up. Even though the Dow Jones has gone down, S&P has gone down, the bullish percent has held up. And that reminds me of how 1982 was. And you can watch for a divergence here. In 1982, you had a major divergence in small cap stocks that began to really take off and run, while everyone was still focused on the indexes, the large cap stocks. The small stocks were taking off. Which of those stocks will be the play now? I don't know. You tell me.
Right. Yeah. Well, things are definitely doing. It's interesting that when we bottomed in January, the bullish percent was down to 14 and a fraction percent, and here we are today. I think, Paul, you said the intraday reading we're down about 2% today.
Yeah, 2%, around 26%.
Yeah. So we're around 26% today. So we're a good 10% higher today. But yet the Dow is about 120 points from new low. The S&P 500 is below its January lows, and breaks the spread triple bottom today. But yet you're not seeing as many stocks give sell signals. So things are, holding up better, and that's going to, I think, when you get that NYC reversal back up into X's again, I think it's going to take some people by surprise. And when you look at a lot of major corrections, like October 2002, we hit in the Dow. Actually, in 2002, it was July was the first low. Then you had an initial rally up that lasted for about a month and a half. Then the markets came back and retested those lows and hit new lows in October, but yet the bullish percent didn't go any lower. So the next reversal back up was really what took off. You saw the exact same thing in 1998. It came back, you tested it in the indices, but the bullish percent made a higher bottom, and your next reversal up was a really great buying opportunity.
It's really no different than probing for a bottom. If you're trading commodities, you start off with a commodity. Say you're buying corn, it's above the trend line, gives a buy signal, you take one position, one contract position of corn, and corn pulls back, gives you a sell signal, you stop your position out. The next buy signal, you probe again for a trend, and you buy and you stop on the next sell signal. The next buy signal comes up, you probe again, you keep probing and probing and probing till you find a trend. And that's what it almost seems to be like, the bullish percent reversing like it is here. It's almost like probing for a commodity trade.
Yeah, exactly.
And usually when you have situations like this, you have to see something or some company go bankrupt before you start reaching a bottom. And it seems like every bit of news that you can think of is out already. If it's not out now, I don't know who could possibly keep it in. Well, Bear Stearns.
They did a good job of it.
Bear Stearns. Yeah, I got to say that. Bear Stearns a few days before this happened was still saying, "Hey, our cash position is fine."
Yeah, they're saying it hadn't changed.
Hasn't changed,
which is not fine. But saying that it hadn't changed. So.
But one thing that in reality about what's happening with your customers is my brother-in-law called me this weekend. My brother-in-law, the most unlikely person you would ever expect to even utter the words Wall Street stock or brokerage firm, called me up and said, "Are we in trouble at Bear Stearns?" Which is where their accounts and the number of accounts that we manage are, because we go through Northeast Securities, which is a correspondent of Bear Stearns, and the answer is no, you have no problem with it, and especially with J.P. Morgan buying the company out, you're in better shape probably than you were. You're in better shape than you were before. But the point is, if he calls me up, your customers are calling you up and wondering what's going on here in Wall Street.
That's right, exactly, and I think that's the whole thing, is shaking the confidence. But like you said, I think that's the way bottoms are made. Is here you would have. To me, that would be a classic setup. The bullish percent makes a higher bottom, and you have a Time Magazine, Business Week, somebody come out and say, consumers' confidence in all financials is shaking completely. And
this is
that
the classic setup.
That would be a classic setup for market bottom.
Everyone talks about recession. recession. I think about the recessions we've been through, like in 1981, 82, 80 recessions. Interest rates were extremely high then. I look at 1990, and the interesting thing about the game that we play, which is the stock market game, it looks ahead.
Yeah.
And once the recession does in fact hit, and all the news is out, and all the people on Wall Street and all the media really climb on it and says we're in a recession, the stock market's already looked ahead 18 months.
That's right.
You know, so what you're experiencing right now, or have been experiencing this kind of volatility, is the expectation that a recession is likely to hit. Once it does, it's no big deal.
And I think the other thing too that this kind of continues to remind us, and it happens all the time, is that trends that get intact stay much longer than anybody ever anticipates, and they go to much greater extremes. I mean, if you look at, for instance, the technical attributes of Bear Stearns, they turned to 2 below that critical 3 level when that stock was still above $120, and hasn't upticked above that. So things just like the trend in the dollar continues to be negative, continues to hit new lows. The yen is in the currency model and continues to move to new highs. So,
currency model has done fantastic, which is so you should make that part of all of your non-correlated asset portfolio.
So I think the key is, instead of trying to catch a falling knife on anything, is to just stay with the trend. You don't know how long they're going to last, how explosive they can be, either to the upside or the downside. So what you have to do is just make sure you follow the signals and stay with them. And if you do that, you'll be in the right direction. I mean, if you look at, for instance, the IAI, which is the iShares Broker-Dealer Index, that RS chart reversed down into O's in August of 2007, and it's still in O's today. So instead of trying to bottom fish those things, it should have told you, why not go over here and look at commodities that are doing better, fixed income,
It's exactly why the mutual fund, DWAFX, Steve, and I'm going to defer to you in a second, the DWAFX has done so well. It's almost like with the DWAFX, it will follow the indicators as it should be followed. As these things change, as it moves toward non-correlated assets, as it moves toward bonds, it's going to automatically do it. So it's like being in your car where you dial in a direction or a place that you want to end, that the car automatically made the turns when it said coming up to this light, make your left turn on the next street, quarter of a mile up. That the DWAFX does in fact do that. And Smith Barney has just come on in the selling group, and also A.G. Edwards. And this is important. I think the DWAFX is something you can put in every customer's portfolio, bar none, from small to large.
Right.
And I would definitely do it and make it part of your portfolio. And it's something to automatically follow. Human emotion is the part that's difficult here. When the indicators tell you to do something, to follow it, like back in November 18th when that relative strength turned to cash and bonds versus equities, it was very hard for people to sit back and say, bonds are king now.
Right.
And where's bonds? How have mutual funds and bonds have done?
They're in great shape. Back to the generic quality, and this is the key, quality fixed income. You're seeing the major bond indices, even on the long term. Not only are they on a buy signal, they're about ready to put in another additional buy signal on the relative strength against the equal weighted S&P 500. So I think we're in good shape on the bonds. But back to your theme on allocation funds. Allocation funds mean any fund that takes a strategy and they mix a variety of assets. Sometimes they have the leeway to pick non-correlating assets. Sometimes they have more limitations. But the bottom line, it's a very important part of the market. The allocation fund market is about $1 trillion big, with big fish in it. Fidelity, American funds, everybody's got a balanced fund, and they try to do what they can. And this fund, the DWAFX, is in the top of elite of all those funds, both in their score and their percentile rank. And
that's Morningstar, right?
Yes. But
this is Morningstar saying it's not DWA.
That's correct. And you're dealing with I think a very important type of fund, the allocation fund, and this fund is through its relative strength strategy is able to maintain at the top of the heap. American Funds has been in this game for many years with Balanced Fund of America. And Balanced Fund of America is a good fund, but it really can't hold a candle to this relative strength approach. So they're doing a good job, and it's because they can take advantage of the other asset classes, whereas other funds, let's say the Dodge & Cox Stock Fund, let's say, or Growth Fund of America, let's say, well, they can't really move into these kind of assets. I mean, that's not what they do. So they can't take advantage of where to be, nor can they get out of the way of the market or where they shouldn't be, because they have to be somewhat fully invested. In fact, American Funds is considered a conservative family, and they can raise up to 10 to 20% cash if they really need to, and I think they're about 10 or so right now. But they're never going to be 70% somewhere else. They're never going to be 70% in cash. I mean, they're roughly 80% fully invested, and many funds out there are roughly 100% fully invested. So you just got to know the type of fund available to you, and then think about the allocation fund market, which allows you to branch out in the other types of the asset classes that you definitely need.
We better go to tape 2. We're at 11 minutes.